Um, and just going a little further in terms of globalization and what is happening in the world economy that affects these companies, there has been significant development in the integration of capital markets. And so what happens with capital and financial markets? Capital markets are where you do what? What are capital markets? So we consider capital markets where you raise capital, where you raise financing, right? So the markets are integrating because of what we refer to as deregulation. All right? And please, you need, once you get that text, you need to do some reading to see what that means. So what's happening is that throughout the world, the US, the UK, France, Germany, even in the Caribbean, all right? Within the financial markets, there's regulation. So there's regulation of the banking system, all right? There's regulation of the securities markets. Those are the two main financial service markets. And there's regulation of insurance companies, all right? You'll learn this in finance, in elements of banking and finance. So those of you who did FINA 2001, you would have learned about regulation as well. So there's regulation. You have to regulate the markets in order to protect customers and to protect economies, right? Because your financial markets are so intertwined with the economy that whatever happens, for example, in the banking system is going to affect the economy. So they have to be regulated. What has happened over the years is that regulation is being harmonized, all right? And then countries are removing some of the restrictions that were there before. And so because of this deregulation, the markets are integrating. What that causes though is when America sneezes, we catch a cold, right? When one market goes down, there's a ripple effect around the world. So there are risks from that, which companies have to look at. All right? There's increased competition and financial innovation. All right? What does all that mean? Increased competition and financial innovation.
They come up with new ways to raise funds or to make money.
New ways to raise funds, yes, and they come up with new ways to do things. So in banking, you have something called fintech. In fintech, what fintech does is fintech allows you to move money without the banking system. All right? So the ECCB, Eastern Caribbean Central Bank, they are piloting something called eCash. All right? Which is EC digital, EC currency. In the US, they have something called Cash App. They have something called Zelle. They have something called, there's something else. Cash App and Zelle is the main one.
Venmo?
Yes, all right? So you have, fintech is allowing smaller companies to have the opportunity, give you the opportunity to move money without the banking system. So it's all electronic, all right? It's, somebody has an account at the bank somewhere,
Right, exactly.
right? But you can just you use your cell phone and you transfer very easily. Similar to mobile banking, all right? Peer-to-peer transfers, you familiar with that? Anybody uses peer-to-peer transfers? All right? So the person has an account at, you have an account at the same bank, the person has an account at, you do a peer-to-peer. All right? So financial innovation is critical as part of one of the developments in the world economy. Then you have new investment instruments, all right, multi-currency bonds, international mutual funds. And so there are all these developments in the world economy that supports globalization and that companies have to pay attention to and be able to manage, because all of these things come with risk. All right? And then another major world development is the introduction of the euro back in 1999. All right? The US was what you referred to as the main world currency, but the euro came in as a currency that could rival the US. Okay? And so that was a major development on the international market, in the international financial market. With the advent of the euro, what you have had happening is that you have multiple countries being able to trade with each other without a problem. All right? And so the euro, what that did is it gave a certain amount of competition to the US dollar. Because no longer European countries, they traded among themselves, yes, but they don't need to get US to trade with each other. And even countries outside of Europe don't need US. They don't have to convert to US, then convert to euro. They can go straight to euro. So that advent of the euro would have contributed to further developing the capital markets in Europe. All right, so you have more investment instruments in a currency other than the US. You also, because of the introduction of the euro and the integration of the countries in the economies in Europe, you also had increased merger and acquisition activity. So, I've spoken a lot. What did we talk about? What is globalization? The interconnectedness of countries, not just countries, but
Businesses.
governments, businesses, education. All right, good. Why do companies expand beyond their borders? More opportunities. What else? Economies of scale to lower their costs. Yes. Okay, good. All right. Let's see what else is important. There are more opportunities, but there are also what? More risks. What are those risks? Foreign exchange risk and
Political risk.
Why is political risk a factor for multinationals?
Policies change.
Regulations, taxes, all right, changes in regulations, changes in policies will affect companies. What currency fluctuation is one of the main, or foreign exchange risk is one of the main risks that multinational companies face. Why is that?
Currency fluctuates based on demand and supply.
Currency fluctuates based on demand and supply, yes. And so what is the risk? What is the risk to the company? That the currency will change, the value of the currency will change. All right, and we'll see quite a bit of that. We'll see the examples of that, how that works. All right, so in a nutshell, that's your introduction to international finance, international financial management, the concept of globalization and the international firm. And knowing that globalization is not just between a country's government, but it's in terms of businesses, education, all of those things. All right? So I would have posted those slides in the Moodle space. But it's very important, if you look at your course outline for those of you in 3053, for those who came in late, we have two groups in this class. One group is doing international finance, and the other group the bigger group is doing international financial management. And so because we're looking at international financial management, all right, we'll do a little review of the concepts that are involved in management, okay? So this is not as important for Heaven and Rachel, all right? So they're doing the Econ 3007. But I just want us to just go over a bit what financial management is about. What is financial management? So we're not adding the international here now. We're looking at what is financial management, why is it important to companies, without adding the currency risk and so on. When we talk about financial management, what is the crux of financial management?
To make sure that while the goal of the company is to make profits, and
Goal of company is to make profit,
but there are risks that are involved, and
there are risks involved, yes.
and you need to be able to manage those risks, so that
You have to manage your risk, yes.
so that you can continue to be profitable. Yes.
You continue to be profitable, but a company financial management is about making good financial decisions.
Okay.
All right? And the crux of good financial decisions mean you need to reduce your costs all around so you can make the profit, right? And so, in order to reduce your cost, so you make that profit so later on you can expand, you need to ensure that whatever you invest in, you're getting it at the lowest cost possible, right? In order to get it at the lowest cost possible, you need to value that investment, whatever the investment is. And when we talk about investment, we're talking about financial securities, all right? Financial assets and physical assets. And so financial management is really about bringing down your cost of capital and making good decisions, good investment decisions to be able to do that. And so just as a review of financial management, the basics of financial management, the key point, the basis is valuation, corporate valuation, all right? So you want to be able to calculate the value of a company. Why? You and I, who would like to invest in the company, need to know what's the value. So we don't want to invest in a company that's not of good value. And so the basis for valuation, can anybody tell me what's the basis for valuation? When you're valuing anything, you're valuing a stock, you're valuing a bond, you're valuing a company. What's the basis for valuation? When you're trying to value a stock, value a bond,
The price.
how do you find that?
The price of its assets and
How do you
assets.
find the price of a bond? The market? No, you don't go to the bank. You
Financial
check the price.
statements.
Financial statements, okay. Again, now a little closer. Huh? The cost, okay. what value do you get from an investment? If you have a stock, if you own a stock, what is the value of that stock? How you get the value from the stock? What's the money that you get back from the stock? Hmm?
I would say
Well,
like,
Rachel?
like the
A
dividend.
bond is coupon payments. A stock is what?
Dividends,
Dividends.
right?
All right, dividends. So the basis of valuation is knowing what cash flows you're going to get from
Investment.
the asset, yeah?
Okay.
So for stocks, it's your dividends, and if you sell it, your capital gain or your loss. And for bonds, Rachel said it's your coupons, right? So in order to value a company, a stock, or a bond, you want to estimate the future cash flows. But to estimate the future cash flows, you want to know what the value is today, right? How do you find out what the value is today? You have to take the present value of those cash flows. All right? So, the present value of a bond, or the value of a bond, is the present value of the cash flows from the bond, which is what? The coupons, all right? And the principal you get back at the end. So you have to discount it to the present value. And what do we discount by? What's the rate, what we use to discount?
Interest.
The cost of capital, the cost of,
capital.
okay? Cost of capital means how much you're paying
Mm-hmm.
to acquire it. So the interest rates
Okay.
and so on, okay?
Okay.
So corporate valuation is important to potential investors, corporations themselves, and the owners and shareholders, because the potential investors want to know that they are purchasing a company that has good value, right? The company wants to know what is the value, what is its value, and a company's value is the cash flows that it's going to get. Then if the company wants to invest in another company, wants to acquire another company, is going to try to get what is the cash flows that company can potentially give to us, that other company. And so the basis of corporate decision making is valuation. All right? And it's always the cash flows. So once you understand how to work out present value, you don't understand how to value anything. All right? So for corporations, the value of the stock is the most important thing. All right? For those companies that trade their shares, the value of the stock is the most important. The value of the stock depends on what? The profits the company is going to make. So the company is focused on maximizing its profits. To maximize its profits, it needs to ensure that it's reducing its
Cost.
costs. All right? So complete valuation includes valuing the assets of a company, determining how much working capital the company has, and the long-term capital the company has available to it. So we're just doing this review as a basis for going forward with our international financial management, right? Because the fluctuation in currencies is a cost, okay? And will affect the value of a company. If Toyota Motor Company, resident in Japan, its financials are in Japanese yen, the value, the total assets of Toyota Corporation, let's say it is 10 million yen. If the yen depreciates against the US, and the company, and through the depreciation, the yen is
Okay.
valued less, it means the company is valued less. All right? So what I'm doing here is going back to the basics of financial management so you can make the connection. All right? So to value a company, you're going to need to review and analyze the balance sheet. You use your financial ratios. That was in FM1. I know some of you, it may have been a blur. Don't worry. You'll just get a little bit of a review of it in tutorial on Friday. All right? So determining the cost of capital is important. Cost of capital is how much it's going to cost a company to get the funds to expand, all right, or to get the funds to run the business. Cost of capital mean, if it's a loan, what is the interest rate on the loan? If it's bonds, what is the interest rate on the bonds? If it's equity, how much it costs you to issue the shares, all right? As I said before, fundamental to valuation is the concept of present value, and that is because the value of the firm today is going to be different to the value of the firm tomorrow. But the value of the firm today is really about the potential, the firm's potential to earn. All right? So the future cash flows to the company need to be discounted to their value today, so you know what the value is today. So that is why present value is important. Okay? Hope we're not going over your head too much. You remembering anything about FM1? No? All right. So the present value of a cash flow in the future is whatever the cash flow is going to be in the future discounted to today's value. And how we discount it, we either use the cost of capital or we use the risk-free rate. What's the risk-free rate? Huh?
It's the
The
US.
treasury bills, yes. The US, the government treasury securities. So if you're looking at a 5-year investment, so your cash flows go out to 5 years, you're going to use the rate of the 5-year bond, whichever government. If you're in the US, you're in the US treasury. If you're in Antigua, you're using the Antigua government bond. All right? So we use a discount factor. Discount factor is always less than 1. All right? If it's more than $1 today, is going to be worth less than $1 tomorrow. All right? My timekeeper working? So what I have here is just, I write it on the board because when I write in this slide, it doesn't, remember to bring my tissue with me to wipe the board. On my, I'll remember to bring my duster upstairs. All right, so your present value is really your discount factor times the cash flow. So your present value is equal to, all of that I have on here,
What's that?
is your cash flow divided by 1 plus whatever your discount factor is. All right? So your time. Now, so that is if it's just one cash flow. If it's more than one cash flow, your present value is equal to the sum of all of your cash flows divided by 1 plus. What's R? Or sometimes people use K. That is your discount factor.
Discount factor.
all right, your discount rate, all right? Now, what you're seeing there is really 1 over 1 plus R to the n times your cash flow, which is the same as this. This is the same.
Okay.
All right? So the rate of return that your investor is going to get depends on the payments in the future and whatever those expected cash flows are. All right? So the present value formula is the basis for valuing financial assets. You need to know what the cash flows are. Your cash flows for stocks are what?
Dividends?
Dividends, right. And if you sell it, you sell the
Capital
price,
gains.
right? And your capital gains if you sell it for more than you bought it for. Capital loss if you sold it for less. For a bond, your cash flows are what? The
Coupons?
coupons and the principal that you get back at the end.
Okay.
All right?
Right.
So that's a quick review. Like I said, in tutorial, the tutorial lecture will go over that. When you're valuing long-lived assets or companies, again, you're using the same formula, where present value is equal to your discount factor times your cash flow. Now, your discount factor is this. All right? In your financial management textbooks, you would have had the tables at the back,
Yeah.
all right, which would give you a discount factor. So it's 10% for 12 periods, and you would find the discount factor. Okay? So if the cash flow from an investment a year from today is $1,000, if you were to use the present value formula, and we assume that your discount rate is 5%, your present value of that $1,000 would be what? 1,000 over 1 plus, your rate was 5%, I told you. 0.05, and it's just 1 year, so that's 1. Okay, so what's the value of $1,000 a year from, what's the value, $1,000 a year from now is valued what today? So it's 1,000 divided by 1.05, what's the answer? Alright, so that's just a quick example. But you can evaluate the cash flows several years into the future. Now, financial calculators give you the luxury of punching it in and you get the answer. But if you don't know how to use a financial calculator, you're in trouble. So those who have had me in classes before know that I love to teach the long way. So that if you get tripped up in your exam, you just go back and you do it the good old-fashioned long way. All right? Any questions there? And so what I'm showing you here is that the same formula can be used to discount a series of cash flows. So you have the cash flow 1 divided by 1 plus your discount rate, plus your cash flow 2, so the cash flow in the second year, divided by 1 plus whatever the rate is, squared, because it's 2 years. If it's a third cash flow, same thing, but it's cubed. All right? That's your discounted cash flow formula. It's used both in stock and bond valuation. Just that with stocks, you have different formulas. So your constant growth rate formula, your multiple growth rate formula. But we're not going to get into that. We're not going to stress you out with that in this class. But later down, you're going to have to do just a little bit of it. All right? and you will get a little practice on Friday. Stock valuation, like I said, is done using different methods, different formulas, and so that's really all that I need to tell you. Understanding how stocks are traded is also important, all right? So you understand how they're valued, because somebody is going to purchase a stock because it expects the price to increase down the line. So they're going to do a valuation based on the expected cash flows, all right? And so from a stock, you're going to receive your value from your dividends, and you're going to receive value from capital gains, because you're going to try to purchase the stock at a lower rate than you expect it to be in the future. So we said all of this before. The value of the stock is dependent on how much dividends you will get from the stock, and the company is going to pay dividends based on the profit it makes. So a company may decide that it's only going to pay the $1 per share for the next 10 years, but 10 years down the line, if we evaluate, it says we're making some money, so we're going to increase it. All right? We're going to increase our dividends by 5% every year. So it all depends on how the company is performing. We're not going to get into dividend policy, because companies also have policies by which they determine what their dividend is going to be. But like I said, this is just a review session, so that you are reminded that as we look at international financial management, what is the basis of value in a company and what goes into it. So a company, the value of a company is going to be its future cash flows. What is the future cash flows? It's going to be your income, all right, your net income, all right? And usually we use operating cash flows as opposed to total net income. So your daily operations, so we're gonna get that. We're using the operating cash flows, where we're going to take out, we're gonna take out your taxes that you pay, and then we add back the depreciation. But like I said, we're not going to, you did all of that in financial management, but it's just a reminder to bring you forward into international financial management. All right? Any questions? This just gives you, I'm not going to go through that in a lot of detail, the different types of dividend models. So you have the generalized dividend discount model, which is really this, all right? Then you have the Gordon growth model, which is a very simple model. Then you have this constant growth model, and then you have the multiple growth model, which combines a constant growth model with the dividend discount model. Valuation is also done using what you refer to as extrinsic valuation. So you use your ratios, the PE ratio, all right? The price earnings ratio is also another way, but it's also called relative valuation, because you have to compare it to a similar company. So you're comparing the PE ratio of one company versus another to see if that company, the relative value of that company to another company. But the more popular one is the dividend discount model, as opposed to your relative valuation. And so I've put there, you have on the slides the different models, all right? And like I said, we will do some of it in the tutorial, just a review, okay? Any questions? Before we go, I need So do you have any questions, concerns? No? You good? All right. I'm not gonna be talking so much from next week. You have to talk. All right? Okay. So, Alicia Christian. Don't say Alicia Blue. Damien Henry. Brianna came in, yes. Cara Mills. Carolina Novas. Oh, Carolina. Okay. Sean, come in. Josh. Josh Small, no. Shema. You're Shema, right?
No.
Terrence Weatherhead.
Yes.
So who's going to be our tutorial teacher?
Her name is Miss Brown Joseph. You don't know her.
No, I don't know. Okay. The same, for the same, both tutorials? Oh, okay, okay. Is that it? Alright.
All right, so I see some of you tomorrow. What's today, Wednesday?
Yes.
No, see some of you later,
Yeah.
and
2076.
some of you on Friday. How many people have my next class today? So I have some of you 3 times.
Wow. That's insane.